Greetings, everyone. Thanks so much for joining us this morning for Axion's Coffee Talk. Axion Risk Management Strategies is an organization that's 34 years old, based in the Midwest. We are insurance brokers, risk management consultants, and employee benefit consultants as well. And what we love to do is be trusted advisors. And so today we have John Bramlette from Busey Bank here to speak on a couple really unique items that are affecting our market, specifically here in the Midwest, for those individuals who run organizations and for organizations as a whole. John is a friend. John is a business colleague. He's also a trusted advisor of myself and of Axion. Really excited for him to speak. He's going to touch on a couple key topics. And I don't want to steal his thunder, but a few of the things are going to include long-term capital gains and some of those new implications that might come out. He's going to touch on the step-up basis and some ways to transfer assets moving forward. And he's also going to talk about the environment and how some of these new regulatory issues might affect businesses moving forward. Without further ado, John, please introduce yourself, introduce Busey. Let's get into the conversation.
Morning, everybody. Thanks, Jake, for the kind introduction, and appreciate everybody's time today. Hopefully this is one of the last WebExes we can have, and looking forward to start doing this in person, as well as just getting through this nonsense that we've all been dealing with. Quick bio on me. My name's John Bramlette. I work with Busey Bank. I am a vice president focused in the commercial lending space. Busey Bank's been around for about 152 years and predates the University of Illinois by a year. We recently acquired Glenview State Bank, and we've got approximately $14 billion under assets under management in both the wealth side and the on the bank side. So moves back and forth a little bit. We're always kind of fighting each other who can be on the top from the balance sheet perspective. I currently live and work in Naperville, but I was born and raised in Flossmoor, which is far south suburbs. And I've been in the middle market commercial banking sector for over 17 years, focusing on growing businesses for growing business wealth, as well as family and personal wealth. Today, we're going to talk about capital gains. What are they? Capital gains are taxes that are assessed anytime an asset is sold for greater than the purchase price. So we're going to focus on the long term first. Currently, the maximum long-term rate is 23.8%, and that includes the 20% capital gain tax, as well as the 3.8 surtax on net investment income, which was created by the Affordable Care Act. The Medicare surcharge currently only applies to individuals earning more than $200,000 or married couples over $250,000. The long-term capital gains are any gains held over 12 months, and short terms anything less than that. With the capital gains rates of 2020, single people at 0% if they're earning less than $40,000, 15% if you're between 40 and 440, and 20% if your earnings are greater than 441. If filing married, 0% if you're under 80, 15% if you're between 80 and 496, 20% if you're over 496,000. The Biden administration's proposal is being discussed. The maximum long-term cap gain rate is going to be 43.4%. That consists of 39.6% capital gains tax, which is doubling what you have previously, plus the 3.8% Medicare surcharge. This would make long-term capital gains the highest taxed income we have. This rate is anticipated to apply to those who are bringing in over $1 million in annual income. I know what you're thinking. I don't make over $1 million. Hang in there. Short-term gains are currently taxed at the rate of ordinary income. So the only proposed change is the top tax brackets going from 37 to 39. 2% increase seems pretty paltry when you're talking about doubling the long term. Let's shift gears and talk about the capital gains and inheritance. So current inheritance exemption level that's been put in place during the Trump administration is 11 million individually and 22 million for couples. Under the proposed bill, the inheritance exception is going to be reduced to 1 million for individuals and 2 million for married couples. While the administration is pointing to the change only affecting the wealthy, it's not really accurate. with the proposed elimination and the step up in basis. So step up in basis means if you're middle class and your mom or cousin left you an estate and they bought a house on a beach or stock or a business or something for 100 grand, sat on it for 20 or 30 years, and now that $100,000 investment is worth 2 million bucks. Well, that's 1.9 million of capital gains, all long term. Under the previous administrations for quite some time, the long-standing step-up basis allows for the person who's inheriting this, the new cost basis is $2 million. So they're not going to have to pay their 1.9 in long-term gains upon receiving this from whoever left it to them. With the proposed legislation, the new amount would be any amount over $1 million would be taxed, and the recipient would either have to come up with cash, get a loan, or sell the asset to pay the tax bill. So there's some caveats that kind of lessen the blow a little bit, such as if that individual spent significant money like investing in the house or repairing, they put in a $50,000 kitchen or something, all of a sudden the cost basis goes from 100 to 150. So your gain would go down from 1.9 million to 1.85 million. Not really a huge change, but the issue with that is the burden is then on the individual who's going to leave the asset to the person by maintaining documents to prove that they've been spending this money. Whereas before, person dies, you got a $2 million asset, it transfers, and your new step-up basis is 2 million, as opposed to having to pay taxes on anything over the $1 million limit. Excuse me. At the end of the day, basically, it boils down to if you're leaving somebody something, you need to make sure that you're planning ahead. You got to have cash, or be aware that they may have to sell the house you're leaving them, or sell the business, or do something in order to afford the taxes that they're going to get hit with. There is some debate as to whether or not the step up is going to be completely eliminated, modified, or left alone. And what we're currently seeing is there's a push towards elimination, but with the split Senate, I'm hopeful it doesn't get completely eliminated, and hopefully at a minimum, hopefully it's left alone, but at a minimum, hopefully it's just modified. For business owners, the elimination of the step up would likely be a massive blow to a value of a company should the entrepreneur have had the company for a long term. So let's say somebody started a company 30 years ago and it's grown to a value of 8 million bucks. Under the proposed Biden administration plan, upon transferring the business, assuming that it goes to somebody outside of the direct family bloodline, the tax event would be 2 million bucks. So if they were going to sell the asset, realize it, excuse me, the step up basis, they would really get clobbered on taxes. Should that entrepreneur not have reinvested in their growing business and instead plow the money into life insurance, and that life insurance is worth the same 8 million bucks as the value of their business, this would all transfer to the heirs, no tax consequences, because life insurance is not going to be taxed. So what are the takeaways from this? What does it mean to you? How's it going to affect you? Because maybe you're not making $1 million a year. I'm not in the upper tax bracket. Due to the ever changing nature of the tax code, investors with long-term investors shouldn't necessarily view this opportunity or penalty, however you view it, as a reason to run out and sell. This is a situation where even if a rate is high, holding until the situation improves may make sense. Think about the Trump tax cuts from 4 years ago and the new inheritance exemption levels that we got when he took office. There's no need to panic sell if you're going to maintain a very long-term outlook, as these tax laws can be adjusted with the next administration in 4 to 8 years. Additionally, the changes that we're talking about today may be retroactive, and any panic selling may actually be detrimental to one's assets. So after this, don't run out and liquidate and start getting ready to do it on your own. Wait for the new tax plan to come out because there's a decent chance you'll already have missed the boat. An area that may have an enhanced value with the new plan in place is the value of IRAs and 401ks. as those won't be exposed to the surcharge and allows for greater tax control. Additionally, the value of index funds and individual stocks and bonds will be enhanced as mutual funds are required by law to distribute their capital gains annually. What is important is long-term planning again. I'll repeat, it's crucial. Meet early with your advisors, meet early with your professionals. With the step-up basis in place for the many previous administrations, people have gotten habit forming over generations, and they're growing their individual wealth to pass along to their families. It's allowed people to operate in a vacuum and surprise their heirs with what they've amassed. In my opinion, the new plan poses many new challenges, and it takes a coordinated approach to maximize your tax efficiency. No matter your personal situation, tax plan may affect you. So should you stand to inherit assets, sell a business, plan on passing along a significant amount of assets to others, or be lucky enough to be in the top tax bracket, this will likely affect you. Every individual's holdings and wealth and future plans are different. And the most important thing you can do is, regardless of administrative policies that are in place, whoever's in office, is to have a solid plan that remains fluid. Talk with your spouse, talk with your business partners, talk with your children, whomever you feel is necessary to bring into the discussion. I strongly recommend planning early and really adjusting your plan as your individual picture continues to adjust, as well as the laws change around us. Reach out to attorneys, wealth managers, bankers, insurance brokers. They're all happy to help you out and get you through and get you a nice custom suit that's fitted for your needs. Find people you trust and you like dealing with. On the wealth management side, find an advisor who's a fiduciary, as they're bound by law to do the right thing by you and your plan, and they're not incentivized to sell you any individual assets that will reward the wealth of their firm. Shameless plug for Busey Wealth Management. We are exclusively fiduciaries who are focused on tax efficiencies and estate planning. With all that said, think of what your business, your family's goals really are. And should your assets be above these amounts, really focus on consulting a professional. Other than the shameless plug, it really wasn't intended to have this information be kind of a call to run out to professionals and go spend money. Ways to get around that are start with a banker or wealth manager, and an insurance broker, because those guys don't bill by the hour. But honestly, if you've got a big chunk of wealth and you're dealing with wealth transference, you really need to get your arms around the complexity of what these new rules are going to be. It's a little early to start now. It's never too early to start the conversation, but it's too early to start making concrete plans, given the fact that the new administration has not yet released its final plans. But what I really see happening is people are going to be likely motivated to start moving more of their money to their next of kin and future generations before they pass, as opposed to kind of the current trend that people have done over generations, which is amass a giant egg and then pass that on to the next generations upon their passing. So that's it.
John, well done. Very well done. I had a couple questions that I wanted to jump in and ask you throughout the conversation, but you were on a roll, so I'll just let you keep going. You talk a lot about what you can do from the side of the investor. We're building up this massive egg, whether we deliver it to our heirs or recipients prior to passing or post passing. But my question is more so on the side of the heirs and the recipients, whether it's a business or whether it's family members. Is there anything that you would suggest or your team would suggest that they prepare for on their end to be recipients of these generous gifts?
Sure. That's kind of that's a good question. So what I would say is it depends. There is no right answer to that. As far as what the best thing in my mind, if you're flexible enough to talk with your family, talk with your next of kin or your heirs, and let them know what is coming. If you have that kind of relationship with those people, which hopefully you do, I think it is crucial to bring them into the fold early, for a couple of reasons. One, as the senior person who is going to be passing on those funds, you can help educate those people as to how you've amassed this money, how you can continue growing in the future. Because in my mind, the overwhelming majority of people have amassed this money, one, because they enjoy going through the process, but two, the real most important part is they're really trying to better their family and their family's future. So how do you carry that on? Talk with the children, talk with the heirs, talk with whomever, and have them understand the assets that are going to be passed along. Meet with a professional, or make sure that you understand the tax code inside out and backwards, and figure out a plan where it is the most efficient way to continue to grow the assets as well as transfer them without giving it all to the government. And, obviously taxes exist for a reason. We all pay our fair share, but let's operate as efficiently as we can and not give up all the hard work that we've all strived for our whole lives.
Love it. Makes sense. Good advice. Last question. We're talking about a specific subset of earners here, clearly. From the business side, are there any specific industries, businesses, types of businesses that you think may be more affected by some of these pending changes? You might not have the answer now. You might not be able to share that answer either, but I thought I'd ask.
Yeah, that's, I would say I think real estate's going to be challenging. There are going to be other challenges in just anybody who's got, I'll say, an asset-based business. You've got a commercial and industrial type business. You've got heavy balance sheets. If you're more of just a brokerage house and you don't have a whole lot of assets and you're just running strong P&L, you're pulling money out of the business, then you're going to have more of a personal issue. If you've got large balance sheet type businesses where you've got real estate, you've got the factory, you've got all the ancillary components that go with that, or real estate investors who have swaths of properties, those are going to be challenges, and you need to start discussing it early, because it may take years and years in order to make sure that the most efficient transference of wealth occurs. Like I said earlier, I think a lot of people are, if the legislation passes in the form that we're seeing, I think a lot of people are going to start gifting or selling portions of their business, portions of their estate to their heirs. So if you own a commercial industrial type business, you're the sole owner and you're growing up and you're getting older in age, and you know that you're either going to be giving a portion of this business, all this business, to an heir, or you're going to be likely selling it to people who are currently, key employees. The time to start working on those plans is now, because I can't tell you how many times I see it. It's 95% plus of the time. People just say, "I'll deal with it tomorrow. I gotta deal with the fire in front of me at my place of business, and I'll deal with the estate planning later." All of a sudden, they're up there in age, and now they've got an enormous tax issue that they can't dig themselves out of. So if you start early and you just kind of keep chipping away at it, it's not a big deal when it comes down to it. If you deal with it all at once, it's a big pill to swallow.
I agree with you. I think that's the best advice you could give. And we all know that this isn't something that you can turn on a switch and your plan is set. This is a multi-step process. Everything is typically tailored to the individual, to the business. So really good advice, John. I appreciate it.
All the assets that people have amassed, sorry to cut you off there, Jake, all the assets that people have amassed over the years, Rome wasn't built in a day, and it's not going to get taken down in a day either. And you kind of got to think about it as, how much time have you spent building your nest egg? And, it's going to take a fraction of that time maybe a significant fraction of that time to start unwinding it if you're going to do it accurately and with efficiencies.
Well said. Very well said. And great presentation, John. Before we close, I want to give you the opportunity. Any final comments, takeaways?
Plan early, plan often, talk with your family, talk with your business partners. Communication is key. And while I think a lot of people have historically not talked with next of kin, I think the current plan that the administration is talking about is really going to force a lot of those conversations, whether they're good or bad, for people to have them early and ahead of time. I don't know, but I would say from a financial perspective, it's definitely better to have those conversations early and ahead of time.
Well said. John, we really want to thank you for your time this morning. Extremely insightful. Thanks to Busey Bank for letting you put this on with us. Again, for everybody watching, John Bramlette with Busey is a great partner of ours, a great friend of mine. He is a true expert in this arena. And the one thing I admire most about John is if he doesn't have an answer, he finds it out for you as quickly as possible. Like us, he tries to be a resource, and is always has been a resource for his clients and for his partners. With that said, thank you so much for joining us today, John.
Thanks for the opportunity. Thanks for the opportunity. Appreciate everybody's time.